Good evening. I call to order the Tuesday, 15 January 2019 meeting of the Water Company Acquisition Study Committee. This evening we will first review and approve minutes from the committee's 24 May 2018 meeting, at which we unanimously voted to release into the public record all the committee's executive session minutes. Then I will refresh our collective memory with a brief, high-level timeline of the major events and milestones that have occurred during the past 6.5 years since the committee was first formed in May of 2012. Committee members will then briefly discuss how we intend to fulfill the charge to the committee voted by the selectmen during their 11 December 2018 meeting. Finally, we'll address the main focus of tonight's meeting, the committee's review and discussion of the financial analysis related to the potential town acquisition and ownership of the water system. So without further ado, I'll ask the committee to review the draft minutes for our 24 May 2018 meeting for corrections or a motion for acceptance. Do I have a motion to accept the minutes as authored?
Someone who was here.
Yeah, Joe and I assume will be abstaining.
I move that we accept the minutes of the Water Company Acquisition Study Committee meeting of May 24th, 2018.
Do I have a second?
Second.
Okay. All in favor?
Aye.
Abstentions? 2. Okay. No dissents. Thank you. Now let me turn to a timeline of major events and milestones that have occurred during the more than 6.5 years since annual town meeting 2012 approved the article for an investigation of whether acquisition of the water company by the town is feasible and advisable for further town meeting consideration. And I'll direct your attention to the screens to the right of the room here. Town meeting 2012 authorized funding for a feasibility study to address 3 areas: operations, finance, and management. We've since retitled them Financial Analysis, Engineering, and Governance, and agreed that we should conduct the study in phases so as to be as careful as possible with the expenditure of the authorized funding. In the committee's first several meetings, we agreed that if we encountered a showstopper, an insurmountable obstacle, in any study phase, that we would cease the study and report that fact to the appointing authority, the Board of Selectmen. The first study phase was financial analysis, which occupied most of the 13 months from May 2012, when we first met, through June 2013. During that time, the committee also performed look-aheads for showstoppers in engineering and governance and did not surface any. However, the committee was unable to complete its financial analysis because town officials and Aquarian executives could not reconcile the more than $100 million difference between their respective interpretations of the water system purchase price under the 1879 statute, as well as whether the water treatment plant built in 1995 was considered part of the water system under the statute. Having surfaced no showstoppers, but needing to ascertain both the purchase price and the status of the water treatment plant, in late June 2013, the committee voted to recommend that the Board of Selectmen take the steps necessary to begin a potential acquisition. Following which, in order to obtain a legally binding purchase price and formula for rolling that price forward from year-end 2013, as well as to determine the water treatment plant's status under the 1879 statute, the Board of Selectmen voted to initiate litigation in early July 2013. The entire litigation timeline spanned, as you can see, roughly 4.5 years, from September 2013 through March of 2018, from the Superior Court up to the Supreme Judicial Court. The Superior Court issued its final judgment in April of 2016, ruling that the water system purchase price as of year-end 2013 was approximately $88.6 million, and that the water treatment plant was indeed part of the water system under the 1879 statute. Both the town and Aquarian appealed the Superior Court decision. The appeal court affirmed the Superior Court rulings in November of 2017. The Supreme Judicial Court declined to conduct a further appellate review in March of 2018, so last March. So, as of year-end 2017, the agreed-upon rolled-forward price between the town and Aquarian is $103 million and some additional dollars. The estimated purchase price as of town meeting 2019 is approximately $107.8 million. In April 2017, concurrent with the appeal court process, Aquarian filed for a 14.7% rate increase with the Department of Public Utilities, the DPU. Following Macquarie's sale of its Aquarian holdings to Eversource for $1.68 billion in December 2017, Aquarian filed an amendment to its April 2017 rate case in February of 2018. That amendment reflected both DPU-ordered changes resulting from the Tax Act of 2017, as well as an Aquarian proposal for a new annual capital surcharge in addition to the requested rate increase to fund additional capital spending in its Aquarian, Massachusetts businesses, both our water system, which is called Service Area A, as well as the water systems in Oxford and Millbury, which are grouped together in what's called Service Area B. The DPU, Department of Public Utilities, issued its rate case order on the last day of October 2018, following which the Board of Selectmen directed the Hingham Town Administrator, Tom Mayo, to arrange for an external third-party expert review of the town's financial model. A principal from the firm Barry Dunn, specializing in the regulated utility industry, and the managing director of Anderson Tax's valuation practice in Boston presented their respective findings of the model review at a joint meeting of the Board of Selectmen, Water Company Acquisition Study Committee, and Advisory Committee in this hearing room this past Thursday, 10 January. On 11 December of 2018, anticipating a near-term completion of the expert review, the Board of Selectmen voted to charge our committee as follows. The board charged us with reviewing available information resulting from our work in financial analysis, governance, and engineering, and reporting back with a recommendation as to whether the town should or should not purchase the water system serving customers in Hingham, Hull, and North Cohasset. So that's a quick timeline review of what's transpired during the past 6.5 years. I'd now like to propose to the committee that we fulfill our charge by reviewing the work done in each of the 3 study phases, financial analysis, engineering, and governance, in 3 successive meetings, addressing financial analysis tonight, governance tomorrow night, and engineering on Wednesday, 23rd of January. After the engineering discussion on the 23rd, I propose that we vote on whatever recommendation the committee believes is in the best interest of the town and all the water system ratepayers, following which we will deliver our results, or the results of our recommendation vote verbally to the Board of Selectmen at a meeting of their scheduling. Having completed our charge, I think it might be helpful to subsequently consolidate the materials presented and discussed by the committee in a single document for posting on the town website at some subsequent point of time. So I'm going to ask the committee if that sounds like a reasonable way to proceed further.
It is.
Is that the sense of the committee?
Yes.
Great.
It is.
Thank you. Okay.
Let me just ask, John, are you saying that,
You want to talk?
yeah, sorry, that you would anticipate that if we are all comfortable by the end of the engineering presentation, that we vote next Wednesday, or are you saying we would vote at another
That we
meeting
would vote
after?
next Wednesday, at the that we would vote next Wednesday.
So maybe
Yes.
we're all comfortable
Right.
voting at that time?
Yes.
Okay.
Yep.
And our vote would be on a recommendation for the purchase. And that's essentially the question that's being put to us.
Say again?
Recommendation for or against the purchase.
Yes, exactly. Yep.
Yeah, and I think what John was also talking about is, thereafter, creating a report to, I mean, I don't know if the report is necessary if we recommend against.
Right.
It may still be necessary,
Yeah.
but certainly if we say in favor, some kind of report, kind of consolidated.
With a
with that.
rationale.
Right.
Yeah, an explanation.
I think my 2 cents worth says, whatever the recommendation of the committee, I think we ought to document the rationale for what recommendation we came out and voted.
I think that makes sense.
Okay. Good. So at this point, I'd like to ask Ed Siegfried to present his summary of the financial analysis information. And what I'm going to ask of the public here is that wait until Ed is done. I have some remarks following Ed. Then I'm going to ask the committee if it has questions or observations, and then I'm going to open it up for public questions addressing the item on the agenda here. So with that, Ed, turn it over to you.
Thank you, John. Good evening. Ed Siegfried, a member of the Water Company Acquisition Study Committee. I have a lot of information to cover, so I'm going to read my remarks to be sure I don't miss anything. When the Water Company Acquisition Study Committee was appointed by the Board of Selectmen in 2012, we agreed that there should be 3 phases to the committee's work: financial, governance, and engineering. We also agreed that financial should be the initial phase, since if a financial showstopper were encountered, it would make little sense to proceed. This evening, we will provide an update to the financial analysis work done to date, starting with a review of the history of the work done, and then where we are today. A committee meeting tomorrow evening will focus on governance, and a subsequent meeting next week will cover engineering. Almost 7 years ago, John Asher and I, as members of the Water Company Acquisition Study Committee, were asked by the selectmen to do a job and to gather financial information. Neither of us had any preconceived notion of where we thought this would end up. We were simply gathering information. We have gathered a great deal of financial data over the past 79 months. 79 months. Jeez, I think I was in high school when that started. And have spent hundreds of hours in order to analyze and periodically present the results of our analysis, both this evening and previously. In June 2012, when we first started this project, to determine if it was financially feasible for the town to consider purchasing the water company, there was a significant amount of financial information that we could dig into. Macquarie, an Australian investment bank, acquired Aquarian in 2006 and received approval for a 23.42% water increase in 2009 from the Massachusetts Department of Public Utilities. In 2011, Aquarian filed for an 18% rate increase, and the DPU approved a 10% increase to go into effect in 2012. So in 4 years, Aquarian's water rates increased 33%. We reviewed Aquarian's 2012 DPU rate case filing and other information, and also had 3 meetings with Aquarian in late 2012, during which we compared financial data, reconciled Aquarian's expense and revenue numbers, and obtained Aquarian's projected rate increases by year to 2022. The end result of this work during the second half of 2012 was that we identified approximately $6.7 million in Aquarian costs which could be eliminated each year if the water company were municipally owned. This was $6.7 million out of the $12 million the DPU had approved Aquarian to charge ratepayers. Once we understood Aquarian's cost structure, we were quite certain that a town-owned water company could operate less expensively. The only significant financial unknown at that time was the acquisition price. Since the Board of Selectmen voted in July 2013 to file litigation to determine the purchase price, John and I have been asked by the town administrators, both past and present administrators, to periodically provide financial analysis updates. At the 2014 town meeting, we described in detail the $6.7 million in Aquarian costs which could be eliminated with town ownership, including water treatment plant lease costs, return on the rate base, Aquarian profit, depreciation, income taxes, and other expenses including rate case expenses, corporate overhead, shared office space, legal fees, customer satisfaction surveys, rent for facilities in other towns, and water purchased for resale, all of which totals $6.7 million annually that would be eliminated under town ownership. No labor reductions were included in the total. No water treatment costs or quality control costs were eliminated. What was identified were Aquarian expenses that an investor-owned water company was authorized to charge ratepayers. We stated at the 2014 town meeting that revenue from the eliminated charges, combined with lower borrowing costs of the town, could be redirected to fund both the purchase price of the water company as well as the investment of $5 million in year one for capital improvements, which would address in part the unaccounted for water loss, and $2 million annually thereafter in capital for system improvements. Additionally, the initial borrowing could be used to repay the town of Hingham for all expenses incurred in funding the study and the litigation. All of this revenue would be sourced from water rates, not from real estate taxes. We emphasized that property taxes would not increase if the town ultimately decided to purchase the water company, and that is still the case today. After funding all of this, there would still remain a substantial cost savings difference between town and Aquarian ownership. In April 2016, the Superior Court issued a ruling stating that the purchase price for the water company would be $88,585,821 as of December 31, 2013, using a formula that would allow for the purchase price to be rolled forward to dates in the future. Hingham's expert witness had calculated the purchase price at approximately $52 million, while Aquarians argued that the price should be approximately $192 million. So the court ruling was $37 million higher than Hingham's price and $103 million less than Aquarians. The purchase price rolled forward to December 31, 2017, using the court formula, is $103,022,826. $103,022,826, according to information supplied by Aquarian and validated by the town. Rolling the price forward another 16 months to April 2019, when the Hingham Town meeting might vote on a purchase, the price is estimated to be approximately $107.8 million. The exact final price is still to be determined, as it will depend in part on Aquarian capital spending in 2018 and the first 4 months of 2019. So where are we now? On April 13, 2017, Aquarian filed with the Department of Public Utilities for a rate increase of 14.7% for its Massachusetts operations, including a 13.8% increase for Service Area A, which consists of Hingham, Hull, and a portion of Cohasset. That filing would bring Aquarion's Service Area A base revenue requirement number to approximately $13 million. In June 2017, Eversource Energy announced that it had reached an agreement to acquire all of Aquarion in Connecticut, Massachusetts, and New Hampshire for a price of $1.675 billion. The acquisition was completed in December 2017, making Eversource the only U.S.-based energy company to also own a water utility. In February 2018, 11 months after filing the initial rate increase request, and 2 months after being acquired by Eversource, Aquarion applied for a capital surcharge that would be separate from and additive to its rate increase petition. The capital surcharge is now called a Mains Replacement Adjustment Mechanism, or MRAM, M-R-A-M for short. The impact of the Mram surcharge to Service Area A residents is likely to have a substantial impact on water ratepayer bills, as you'll see shortly. On October 31, 2013, the Department of Public Utilities approved Aquarion's rate increase request with an effective date of November 1, 2018. 2 weeks later, on November 13th, Aquarion submitted a required follow-up document with the DPU called a compliance filing, in which the rate increase for Service Area A was shown at 12%. On November 16th, the DPU notified Aquarion that there were 14 corrections that needed to be made to their compliance filing, and directed Aquarion to make the corrections, including corrections to the MRAM. On November 19th, Aquarion filed a revised compliance filing with the DPU, which included 13 of the 14 ordered corrections. Subsequently, on November 21st, Aquarion submitted a second revised rate compliance filing to reflect additional corrections that the DPU had ordered on November 20th. Finally, on November 29th, Aquarion submitted a third revised compliance filing, which the DPU approved on December 3rd, granting Aquarion an 11.9% rate increase for Service Area A customers. That 11.9% rate increase brought Aquarion's total base revenue requirement to $13,047,168 for Service Area A. In the order, the DPU also approved the Mram surcharge, which is not included in the 11.9% increase. It is in addition to the rate increase. The Mram surcharge will appear on water bills starting September 1, 2019, and will initially include qualifying capital additions placed in service by Aquarion in 2017 and 2018. Thereafter, the Mram surcharge will include the cost of eligible capital additions placed in service by Aquarion in the previous year. Included in Aquarion's recently approved $13 million revenue requirement are many of the same types of costs that we identified back in 2014, which could be eliminated under municipal ownership. 3 of those costs are return on rate base, water treatment plant lease costs, and depreciation. These 3 items alone total $6.6 million, or 51% of the total revenue requirement for Service Area A, again, exclusive of the Mram surcharge. This past October, the Selectmen instructed Tom Mayo, Town Administrator, to engage financial experts to review both the Hingham financial model and Aquarion's financial model. 2 firms were hired, Barry Dunn and Anderson Tax. This past Thursday evening, experts from both firms presented their reports at a joint public meeting of the Selectmen, the Advisory Committee, including the Advisory Committee Subcommittee, and the Water Company Acquisition Study Committee. Julie Keim of Barry Dunn focused on the MRAM and the town's model assumptions regarding projections of future Aquarion rate increase frequency and magnitude. Mrs. Keim's report stated, and I quote, The town's assumption of a 10% increase per triennial rate case appears conservative and a reasonable assumption. The Barry-Dunn conclusion was based in part on the history of Aquarian rate increases in its Massachusetts, Connecticut, and New Hampshire operations, all of which have had annual average rate increases higher than what was used in the town's financial model. Mrs. Keim also spoke about the MRAM, and John Asher will talk briefly about that a little later. Mr. Jim Dondero, a managing director at Anderson Tax, presented his analysis of both the town's and Aquarian's financial models. His expert work consisted of essentially building a third financial model using data from both the town's and the Aquarian's models. He stressed that the Anderson model was an apples-to-apples model, meaning that he aligned certain key assumptions, like capital spending and inflation rate, so that they would be equal. His report stated that the savings in the Anderson model for ratepayers under town ownership over a 31-year period, 2019 to 2049, would be $49,768,000, or almost $50 million, exclusive of the Mram surcharge. Starting in 2049, once the town's water company acquisition debt was paid off, the savings under municipal ownership would increase to $7,400,000 each year. Some of the key assumptions and observations in the Anderson model are, first, the initial municipal debt would include the purchase price for the water system at $107.8 million, plus $1.5 million repayment to Hingham's fund balance for all of the costs incurred in the study and litigation, plus $3 million in additional infrastructure capital, all of which adds to $112,327,567 in debt to be financed over 30 years, with 1 year of short-term borrowing at a rate of 2.4% and 29 years of long-term level payment debt at a rate of 3.75%. Secondly, the Anderson model also includes annual municipal infrastructure capital investment of $2 million per year starting in year 1, increasing 5% every 3 years to accommodate inflation, funded with 20-year debt at a starting interest rate of 3.5%, then increasing 25 basis points every 3 years to accommodate possible interest rate growth over time. The Anderson model assumed, thirdly, the Anderson model assumes municipal outsourcing of system operations based on third-party cost quotes, plus inclusion of certain additional municipal costs, including a water system superintendent, as well as administrative support, in growing all these costs annually at a 3% inflation rate. Fourth, with respect to his observations about the Aquarian model, Mr. Dondero noted several errors, including Aquarian's depreciation calculation, the borrowing interest rate used, and Aquarian's water treatment plant cost projections, which contained errors in the percentage rent and adjustment factor calculations. In correcting for these errors and other items, the Anderson model increased the revenue requirement in the October Aquarian model by $105.7 million, from $40.9 million to $576.6 million. Overall, the Anderson model increased municipal ownership costs from $511 million in the July 2018 model to $527 million, a $16 million increase, resulting from higher municipal capital expenses, increasing 5% every 3 years. The Anderson model also lowered the Aquarian revenue requirement from the town's projection by $71 million as a result of the compounding effect over 31 years of using a lower average 3-year Aquarian revenue rate increase of 7.1% in the Anderson model compared to the town's model, which assumed an average annual increase of 8.06%. The Anderson model also revised the Aquarian model projection and Aquarian claim that town ownership would result in $40 million of higher rates. The Anderson model projects town ownership ratepayer savings to be $49.8 million, not the $40 million in higher costs that Aquarian claimed. The net result adding to a turnaround swing difference of $89.9 million. Mr. Dendero also informed the town that there were no errors in the town financial model, only different assumptions and approach. This is contrary to Aquarian's ongoing assertion, even following Thursday's meeting, that significant errors remain. Aquarian would like to believe that there were significant errors. The experts have verified that this is just not true. Moreover, Aquarian has never backed up that claim with any details. My hope is that Aquarian's claim of unspecified errors will now end, and they stop weaving a misleading narrative. We may have used different assumptions, like the amount and frequency of rate increases, but these assumption differences are not errors. Mr. Dendero concluded his presentation by saying, due to differences in interest rates, the need for equity returns, debt leverage, and cost structure, the town ownership option generates just under $50 million in ratepayer savings over 30 years. Once the acquisition cost is paid off, annual savings increase to $7,400,000 per year. In summary, what we do not know. We do not know Aquarian's Eversource's plan for future rate increases, as well as the duration of the Mram surcharge beyond 2021, following Eversource's acquisition of Aquarian in December 2017. We do not know the exact price of the water system rolled forward to a future date from the agreed-upon price as of December 31, 2017 of $103 million. Based on information provided by Aquarian, we believe the purchase price rolled forward to an April 2019 town meeting would be in the neighborhood of approximately $108 million. And that concludes my remarks.
Great. Thank you, Ed. I'm going to direct your attention back to the screens and follow Ed's presentation to see if I can relate that back to what the committee was originally charged with doing, which was to determine the requirements for a feasible and advisable potential purchase recommendation to the Board of Selectmen. And early on, the committee members agreed that the committee would only consider a purchase to be financially feasible and advisable if 4 criteria were met, and you see them displayed on the screen. First, that any borrowing by the town to finance the acquisition would not in and of itself necessitate an increase in ratepayer rates. That the acquisition in that sense would be what we were calling rate transparent. It's important to note here and to repeat what Ed said a little while ago, that a potential acquisition would not impact property taxes, since all initial and subsequent costs would be borne solely by water system ratepayers. The second and third criteria that you see displayed there basically address the need for increased capital expenditures to fix a system that's almost 140 years old. 13% of whose water mains are more than 100 years old. The fourth and final criteria was that Hingham's fund balance should be reimbursed the nearly $1.5 million in costs that have been incurred over the past 6+ years. That way, ratepayers in each of the 3 towns served by the water system, Hingham, Hull, and North Cohasset, would all bear their fair share of the acquisition costs and the ongoing costs of operations, maintenance, and capital improvement going forward. So, how did the financial analysis results stack up against those criteria? As Ed said, last Thursday evening's presentation by the Anderson Tax Managing Director of Tax Valuation in Boston found no errors in the town's model, approach, or assumptions. Determined that almost $50 million worth of savings under town ownership would be realized using a modified version of the Aquarian model and equalizing assumptions about inflation rate and capital expenditures. That $50 million, as Ed said, would grow by $7.4 million every year after the acquisition debt was paid off, and would increase further if Aquarian's Mram capital surcharges were taken into account. The Anderson tax model assumed level payment financing, which is consistent with the advice that the town's financial advisors, capital market advisors, have recommended. And I have available here just a couple copies of the presentation that capital market advisors made to the town at the Board of Selectmen meeting in August of last year. Further, that the Anderson tax result included accounting for inflation and capital replenishment borrowing every 3 years. Bottom line, with either approach, the towns, up to the point of the review by the expert firms, or Anderson taxes, our committee's 4 financial feasibility criteria have actually been met and exceeded. So, in conclusion, just 2 more slides. I guess the first is, what's the impact from a financial perspective of continued Aquarian ownership? First, from a taxpayer perspective, that Hingham's fund balance would not be repaid. If there's no borrowing, there's no repayment. From a ratepayer perspective, according to the Tie and Bond 2000 Mass Water Rate Survey, which is an annual survey produced by Tie and Bond, the average ratepayer bill, residential ratepayer bill in Service Area A is $730 a year. That represents, that's 23% higher than the average residential bill in Massachusetts. The ratepayer increase, as Ed mentioned, in the DPU order that was effective 1 November, resulted in a residential rate increase, not operating revenue, but residential rate increase of 13.17%, which would result in an annual bill for the average residential ratepayer of $826 a year. The increase for commercial and industrial customers is actually higher than that, somewhat. With regard to MRAM, the DPU established a 2% cap on the annual surcharge that Aquarian proposed in its amended rate filing in February of 2018. That would equate to roughly a $13 per year amount that is cumulative in nature. And so what I have done with this chart is basically to use Aquarian's testimony from 30 March 2018, it's towns 512 and 513, which you can find on the DPU file room, to indicate what the impact of the MRAM surcharge would be on Service Area A ratepayer bills, starting, as Ed said, next September 1st. So years 2017 and 2018 are reflected in the $24 increase that takes the bill up to $850 a year and so forth, basically through September 2022, where the aggregate amount of the MRAM surcharge would take the average bill up to $889, which is over a 20% increase in 4 years. That increase is with no assumption of a base rate increase, which would be additive again. From a town ownership perspective, the taxpayer impact is there is no property tax impact. since acquisition, operation, maintenance, and capital improvement would all be funded by ratepayers. The initial borrowing would repay the almost $1.5 million that Hingham taxpayers have expended since 2012 for the study, litigation, and post-litigation activity. For ratepayers in Hingham, Hull, and North Cohasset, two different approaches have shown that significant savings would result over the 30-year life of the initial borrowing, and those savings would grow to over $100 million aggregate savings 7 years after the initial borrowing is paid off in 2048. Finally, as we heard from the Anderson tax expert last Thursday night, increased capital investment equal to that in Aquarion's 5-year capital plan of August 13th of last year would be accomplished without Aquarion's 2% annual Mram surcharge, which will be applied to ratepayer bills starting this September. I will now ask the committee if members have any questions or observations about what's been presented. Bob, you want to talk?
John, on the scale that they showed us at the blue line, the treatment plant debt is going to be retired in 2034. So from 2034 to 2049, that will be additional revenue or could be put back into either capital or even back to the customers.
Ed, do you want to address that?
Yep.
Yeah, the water treatment plant lease, it ends in 2035, was that your point?
Yeah, I guess that's when the debt is going to be retired according to the graph.
Well, the lease ends in 2000.
Yeah, the lease ends, and then there is a payment to, at some point, I guess beyond that, but that's going to change significantly the revenue.
Right.
Yeah.
It reduces what Jim Dondero presented last Thursday is it reduces Aquarion's revenue requirement. It would also reduce, well, it would not reduce the town's revenue requirement because the town is still at that point paying off acquisition debt. So that's why the dip of the line that was the
chart that you're talking about.
Right.
Yeah, right, yeah.
You want to put that
For
on?
those
Zoom one? Can you put that up there? Or is that
Let
a
me
problem?
see, it's going to,
It's 15, I think.
bear with me
Well,
here.
yeah, it looks like you attached it to your presentation, so it would be slide 20. To
Okay.
yours.
There we go.
Oh, okay, yeah.
Yeah, you-
Okay,
that's
that's,
Yeah.
Right, so
so
you're
Bob,
talking
yeah, right at 2035, the blue line is the Aquarion
Right.
line, and that dips,
It dips down to 2035 when the treatment plant lease basically ends, and
Right.
it's renewed at a rate which is equal to 30% of the fixed rate lease cost that was in effect in 2035. It's about $500,000 a year. So you
Right.
get that temporary dip.
the percentage rent and the adjustment to it,
which he took into
Go away.
account when he did the
Right.
comparison.
Yes.
yes.
John, if you've got, as long as you've got that up there, you might go to 2 slides back to 2013. That's the one, the right one,
Oh,
forward one. That's the one that shows the far right-hand column is the Anderson model that shows $526,000 in town cost revenue, Aquarion's cost at $576 million, and then total savings under town ownership of $49,768,000.
And Ed, I would object a little bit to your characterization of saying that Anderson did a whole nother model. I mean, one of the things I liked about it, that I thought was conservative, was that they used actually Aquarion's model.
Correct.
I made adjustments off that. They did the
Yeah.
bottom up versus the top down.
Right.
Which, as you guys have observed, they didn't say that was the wrong way to do it. It's a different way of
Yeah,
doing
right.
it. But this is the more conservative way.
Yeah.
Yep. Cost, bottom up was cost buildup, top down was revenue projection.
Yeah, based on their statements.
Yep.
And
Yes.
Josh, to that point, while you've got this up, John, if you could go back to page 11, maybe? Because I was not here at the last presentation, but I just want to make sure I understand. I guess it's not consistent, I'm sorry.
We're-
I was
Yeah, 'cause he
looking
had-
at the old Anderson model.
Yeah,
This
he-
is incorporated.
So what
in-
page, just,
Page 11 of this Anderson presentation.
what does it look like?
Looks like this. But essentially,
Okay.
the point is how they constructed their model for the capital expenditures going forward. And as I understand it, they looked at the Aquarian plan from last August.
Is this it, Joe? I can't tell what you're looking at.
Yeah,
Yeah,
it's this
that
one.
there.
we
So
go.
on the far right, Anderson there on the capital expenditure column.
Yep,
So they're looking at an Aquarian plan from last August.
right.
And they accept those assumptions through 2022 and then,
Yes.
put this 5% increase in. So that's
Right.
an incremental addition to what the town had.
That's correct.
in its model.
That's correct.
But it put it in both models.
Yeah.
Right, so it equalized it.
The point that Jim Dondero of Anderson Tax stressed was that he made the capital expenditures equal between Aquarian's modified model and the Anderson model and the town model. Also, importantly, added the 5% inflation adjustment every 3 years, which would have the effect of increasing that borrowed amount, as well as the interest rate at which that would be borrowed by 25 basis points, again, every 3 years, which were also changes to the model that was posted by the town in July.
And the springboard for all of that is this Aquarian plan, which is based
Correct.
upon their review of their system.
Right.
Right. And there's another piece to it, Joe, that was discussed the other day, which is how MRAM factors into this, right? Because the analysis that Joe didn't take MRAM into account, and we heard Ed's discussion about how that could ratchet up the rates. The question then becomes, does the model take the additional capital expenditures into account that MRAM is intended to cover? And I think, subject to what we hear from the public tonight, I think we were comfortable that by Jim's taking their capital plan, which presumably formed the basis for the MRAM request, it by definition took into account what those costs were.
Right. I think his point was that as long as the CapEx stayed the same between the two models, that MRAM would have the effect of increasing savings under town ownership. He didn't distinguish between capital that was MRAM and capital that was in the base
You
plan.
didn't need to know what was MRAM, there's
Nope.
just a capital
Yep.
increase.
Yeah, right.
Any other questions from the committee?
I have other observations,
Okay.
but I would prefer to hear from the public first, if that's okay.
Okay. Before we do that, I just want to, again, kind of going back to the methodology that we used 6+ years ago, and ask Ed. So Ed, from the standpoint of your position as phase leader of the financial analysis, did you encounter any showstopper?
No, nothing that I would characterize as a showstopper financially, that's for
Okay.
sure.
Great, thank you. Okay, I will now open it up for public questions. As is the usual practice, please raise your hand if you have a question or a remark. When I recognize you, please step forward to the microphone, cite your name and address, and address your question to me, and I'll determine who can best provide an answer. Sir.
Jim O'Hare, 11 Heron Way in Hingham, obviously. Gentlemen, I'd like to compliment you on your stick-to-itiveness. This has been a long grind, and congratulations. The
We're happy to
previous...
still be in the town.
Pardon me?
We're happy to still be residents of the town.
You mean nobody's thrown tomatoes or anything yet at you, or tomatoes?
It's early.
Am I correct, previous to last Thursday night, that the commonly accepted number was a savings by the purchase of the town of $136 million? That was a number that I had seen bandied about, and I was under the impression that that had been endorsed. Is that a correct assumption on my part, that the town was, in fact, at least complicit in that $136 million savings? Is that a
Answer
yes?
is yes, that was in the July model that was posted on the town's
That's
website.
correct.
Yeah. The numbers have changed, over the 7 years. There've been significant changes, but yes, you're right.
And that was illustrated, I think, quite forcefully on Thursday night, that there was $47.7 million, which was the bottom line number from the Anderson report. Is that correct? It is, I think it is 49.7,
Yeah.
I'm sorry.
Yeah.
I flipped my digits. That's an $86 million discrepancy between the two, which is significant. In other words, that's a large percentage deviation. Was your committee involved in the situation between the water company and the town with the offer that was made from the water committee to have a joint study made, each, the town and the water company, splitting the cost to have an independent third-party analysis? Was that something that you folks
No,
were involved in?
we
So
weren't.
that was the selectmen's situation?
Correct.
Terrific. I guess the question too with did I understand you, Mr. Siegfried, saying that the savings would be $6.7 million annually by the purchase of the town?
The $6.7 million was what we presented at the 2014 town meeting.
Is that still operative?
Yeah, as I said tonight, the number's now closer to $6.6 million, with just three of those costs: depreciation, return on rate base, and water treatment plant lease costs.
And the total revenues of the water company itself, as it presently
13 million.
is 13 million. That is correct. I mean, that's a big number. I mean,
Can I
a surprisingly large number.
Just make sure we're talking apples and apples. I mean, tell me if I'm wrong, Ed, but I think what you're saying is, when you look at their costs, town ownership versus private ownership, those are costs that we do not have to bear. That's
That is correct.
$6+ million. It doesn't mean that we're necessarily saving $6 million a year, because we have the debt costs, essentially, that are going to be different than theirs.
Those are costs that a municipally owned water company would not have to incur.
Right.
But basically would redeploy.
Excluding the debt.
Well, you'd redeploy that money.
I think what we said was that back in 2014, the same holds true today, those savings or cost eliminations are applied to the debt service.
Right.
Right, so I don't know, it doesn't sound like we're making ourselves clear to you. I mean, it's a little apples and oranges, right? I mean, there's the question of what dollars could be saved by town ownership just objectively. We don't have to incur these expenses because we're not a privately held entity that's trying to generate a profit. On the other hand, we have to buy the company. We have to buy the system, and that's going to be X dollars, and that's going to eat into that $6 million savings. I mean, you just do the math. If it's 30 years, $50 million, it's obviously not $6 million a year.
That's
right?
correct.
So,
Yeah.
Absolutely. So that was the point that I thought, frankly, needed some clarification, and I think it was somewhat perhaps off target, and certainly a comparison of apples and oranges. Terrific. The only other thing is that I am disappointed that we didn't have an independent third party. And I think that perhaps in baseball terms, which being in Boston we're all interested in, it seems a little bit like, to me, that having this hiring your own consulting firm, not yours, but in aggregate of the town, is a little like the Yankees coming to the final game of the World Series at Fenway Park and bringing their own umpires. And a foul ball or a fly ball to Mookie Betts is definitely an out, but watch out for the strikes. Thank you.
Oh, it's an interesting analogy. Mind if I comment? You know, one, this person, as I understand it, was hired to give us an objective analysis. I think a little bit the proof's in the pudding, in that he didn't accept our model. He used their he used the Aquarian's model and came out with an entirely different number, to your point. And he clearly pushed back on a fair number of assumptions that John and Ed made. So, you know, from my standpoint, if I felt that he was biased in some way, that would be problematic for me, and I would be uncomfortable taking what he said, or I take it with a grain of salt. But I haven't seen any evidence that he did anything other than what was asked of him, which is, we're trying to get the right answer and tell us what the hell the right answer is from your perspective. And if the right answer is, that Aquarion's right, that we're going to lose money on this, then let's not do it. So I do take, unless somebody can say that this person didn't do an objective analysis, didn't do the analysis he was hired to do, then I would take exception to that comment.
Okay, Madam?
Hi, my name is Polly Rowe, longtime former Hingham resident, but Hull resident since 2003, and I have been attending all of the meetings, whether it's Aquarium forums or the Hingham meetings, and if not able to attend, I've been watching them. I have one comment, that's my perception, and I also have a question for Mr. Siegfried. My comment is I'm feeling like with the financial perspective, I'm hearing information, it sounds to me, presented about, I call it dissecting Aquarian, but I'm not hearing any information about what specifics Hingham is going to offer. So as I'm hearing, okay, we could do better than this dollar amount, for example, but I still haven't heard anything about these are Hingham, the town of Hingham's concrete plans and what it's going to cost. That's one point. The second point is, for me, it feels like you're not presenting the whole big picture when one isolates the financial perspective from the other components of operations and governance. And I always use the analogy of like buying a loaf of bread. There are some loaves of bread that are pretty delicious and pretty expensive. So you could say, well, gee, I bought a $10 loaf of bread, and someone else says, yeah, but I bought the same loaf for $2. But there's so much that that person who bought the loaf for $2 doesn't tell you about, like the not so good quality ingredients, like the baker is new to the industry and has no track record of being a baker, the chemical additives they put in, et cetera. So for me, it seems to do an accurate comparison. You have to see everything in the big picture. My question, when Mr. Siegfried, you had mentioned about you wish Aquarian would stop talking about the inaccuracies. Whether it's with this board or the Board of Selectmen, has Aquarian been given any public opportunity to give you concrete examples to show where they see the inaccuracies? So, thank you.
Thank you.
Let me address at least one of the, or maybe two of the questions that you've posed. I think in terms of addressing the whole picture, the real attempt of having 3 successive meetings is starting with financial analysis tonight. Tomorrow night we'll do governance, and a week from now we'll do engineering. And those really were the 3 phases that were presented to town meeting 2012 and that the committee was really chartered to address. So I think our attempt is to address the big picture, but to do it in 3 pieces. Secondly, in terms of concrete plans going forward, I think you will hear some discussion of that actually in both subsequent presentations in governance. The structure that the folks that worked on governance will describe, and next Wednesday, Bob will lead off talking about engineering. So I think you'll see some detail relative to what could it look like going forward. Did you want to add anything?
Yeah, in terms of the errors, I think I'm not aware of any specificity that Aquarian has offered in terms of the errors that they contend are contained in the town's financial model. I am aware that Mr. Dondero informed the town there were no errors in the town's financial model, only different assumptions and an approach to the calculation of the models. So I'm relying on Mr. Dondero's comment that there were no errors.
And specifically to, I think, one of the questions you raised, if I understood correctly. I mean, you guys did a whole analysis of costs that the town would incur, and I think one or both of the, maybe even both of the experts, well, I guess just Jim, kind of looked at the cost analysis and was comfortable with that cost analysis.
Correct.
As to what it would cost the town going forward.
Yeah.
So, you know, they're here. I imagine they're not going to be shy. If they have points they want to raise, I, for one, would be happy to hear them.
Mr. Lemnius.
Good evening. Phil Lemnius, Town Manager in Hull. And first of all, I want to congratulate the committee on its exhaustive effort. I've been involved in public administration for almost 30 years, and I don't think I can ever recollect a citizen-appointed committee, a committee of volunteers, spending as much effort and diligence in diving into a very, very important question that affects well over 30,000 residents between the town of Hingham, the town of Hull, and a small group of folks over in Cohasset. So on behalf of the town of Hull, I want to extend our thanks for the thoughtfulness and the thoroughness that you guys have exhibited over a long haul, and it has been a very, very long haul. And I just want to kind of make sure that, you know, for the town of Hull, we kind of understand some of the points that were raised earlier. And as I understand it, and it kind of goes to that question of the $6 million differential between the costs that Aquarian currently has built into their rate for their operations and various overhead pieces, and approximately $6 million less if it were municipally run. And for the audience's sake, as I understand it, there would be that operational cost, and then layered on top of that, or in addition to that, would be the bond acquisition cost.
Correct.
And those two numbers would bring us to under the $13 million that Aquarian is currently operating at. And then as you project the cost Aquarian has already kind of testified to a DPU, that's where that $50 million savings materializes over the course of the next 30 or 40 years. So any way you look at it, is it's safe for me to tell the residents of Hull that, you know, people are making a big deal out of the fact that the residents of Hull and taxpayers and residents of Hingham through an enterprise account will have to pay the bond acquisition cost. But they're already paying a cost that exceeds the combination of the operating cost and the bond acquisition cost in the current rate that Aquarian has established. But they're not getting any equity in exchange for that. And that's one of the big pieces of this, is at the end of the day, the residents of these communities will own this water system. So residents can pay over the next 30 or 40 years $500 million or so and have zero equity at the end, or you can pay $500 million or so and have complete equity. That's a pretty good deal from our perspective, because first of all, the rates year in and year out for many years into the future will be lower. And residents are acquiring the system. They're building equity. And at the end of the term, when you look at this particular chart in 2049, the house is paid for. We have complete equity. If we stay with the current model, the Aquarian private industry or private ownership model, at 2049, we have zero equity, and we keep paying rent forever. Is that a fair analysis?
It's an excellent summary.
Only that you stole my thunder for what I wanted to say.
I'm sorry about that. I'm sorry about that.
Yes, that's a very, I think it's a very fair analogy.
Yep. So, you know, I think that this is a great opportunity, and it's been an opportunity in the making for, what, 130 years or so? So it's only taken about 130 years for the towns of Hingham, Hull, and Cohasset to catch up with 250, 300 or more communities in Massachusetts that have the water utility under municipal ownership or governmental ownership through the MWRA.
I actually think, based on what Selectman Johnson presented in August, maybe it was September, that of the 41 water systems that serve approximately the same customer base, 39 of them are municipally owned. So we're, besides the MWRA.
We're the only one in our cohort.
Yeah, well, the MWRA, okay, okay. We'll talk about that tomorrow.
And then one additional kind of point, Aquarian has been very active in Hull talking about this issue. And they've made, I think, a series of statements that my understanding is are just not accurate. Now, I think a piece of this will be covered tomorrow in governance, but I think it's been already stated publicly by the Hingham Board of Selectmen that all ratepayers will be paying the same rate.
Correct.
Meaning that if you live in Hingham, you live in Hull, you live in the portion of Cohasset that is served by this system, all ratepayers are paying the exact same rate.
That's correct.
There is no rate differential for different communities or different neighborhoods or anything of that nature. And I know that the Board of Selectmen, and I think this will probably be covered in your presentation on the 23rd when it comes to engineering, there'll be a great deal of transparency in the engineering discussion and a great deal of transparency in the prioritization of capital projects. And I find that to be something that, will be very refreshing, that there'll be those projects, and the way in which projects' priorities are arrived at will be arrived at through a public process, at public meetings, with documents that are available for all to view, with testimony, with any ratepayer will be able to come forward and provide testimony and to talk about the capital program that will be necessary for a water system. And that's the other point, last point I would make is that this is a capital-intensive operation. Mm-hmm. Water systems are capital-intensive. Last year in Hull, we had 16 main breaks. And the reason I know that is I get an email, thankfully, from Aquarian every time a main breaks telling me a main is broken. This year, I think we're at 2, and with this cold weather coming up in the next couple of days, I fully suspect we'll have, another blossoming of main breaks. But the reality is, those are going to get fixed over time, and I'd much rather have them fixed without, a 40% overhead on the cost, which is about what is happening now. For every dollar that Aquarian is spending, it sounds like on the ground, when you do that apples-to-apples comparison, there's another 40 or 50%, or actually 100%, marked up on top with taxes and all sorts of other overhead. And it seems to me that we're all going to get a much better bang for the buck from a capital perspective because that overhead is not ladled into the top of it. So again, I think that this is a very interesting and intriguing opportunity. From my perspective as a public administrator, watching how you have walked yourselves through the analysis, it has been a very, very positive experience and a very thorough experience. And my hope is that the Hingham Board of Selectmen ultimately will forward this to town meeting for a positive vote. Thank you.
Will you be coming tomorrow night?
I will be coming tomorrow night.
Because we are talking governance, and having a whole representative would be very helpful.
Make a comment, Phil. The MWRA, I'm on the advisory committee of the MWRA, is only a wholesale company, okay? They don't get involved in the municipal operations and stuff.
I think we need to stick to the financial analysis phase here. So these are questions that would be valid. Sing it? I can. Mr. Gannon?
Good evening. Paul Gannon, 7 Sentinel Road. Also, thank you. I've been trying to go to a couple of meetings. I can't get to all of them, and I'm trying to digest all the numbers myself, and but I know you guys are working hard at it. I have a kind of a question. It was a mention, John, you mentioned in the 6 years or so, were there any showstoppers? And I know when we first started town meeting and there was money to study, and I was not a selectman at the time, but I was an interested taxpayer. And obviously, at the time, I didn't know a lot about what we were doing. We were going to study it. And it was intriguing, as I'm sure it was to everybody, and I was taking note of the presentations that were made. And I appreciated, I think it might have been in 14, when I was given a presentation by you and John, I think, maybe among others, when I was in office. And I was privy at that time to the projections and the numbers and maybe a bit of strategy that obviously were taking part during the litigation. And one of the things that I was concerned about was, where is the number that we don't go beyond, in terms of a purchase price? And you folks gave me a number. And basically, and from my memory, it was in line with the town administrator put out publicly, maybe a year or so before, which was about $75 million. So one of my concerns is that, and I look at all the models, and I'm no expert, so I don't pretend to be. If in terms of buying the house, as the town official from Hull said, we weren't going to go beyond $75 million. And we invested money into litigation and so forth, and time and effort on your parts as well. And then, in my opinion, we were not successful in that litigation because the number was 88, and now with interest it's 103, and then depending on whose numbers you go in, it's 112 or higher. So I guess what I'm trying to understand is, and I think I understood part of it, but if back then we were publicly professing we were not going to go beyond a certain price, I'm just trying to maybe what was the point of setting the price, and why aren't we staying with the price? And I guess, and I'm just asking for explanation, is it because the deal is that good over time? But the impression I got when I sat with you folks and when I heard the presentations was that it wasn't worth it in our interest to go over, say, the $75 million. And I know that's something that isn't just based on my conversation with you guys back in 14, but it was also based on a public statement by the town administrator that that was the maximum number we'd go to. So again, if you could maybe just comment on whether or not the $75 million was a high number that we weren't going to go beyond, and maybe just because I don't know the answer, let me know why we're going to pay that much more. Is there something that changed? I'd just like to know.
Why don't I start? First of all, I would say I've never said that, I've never made any public statement to the effect that $75 million was a cap. I'm aware, because I've heard anecdotally, that Ted Alexiadis did make some statement to that effect. I would say, really, the point is your last question, did something change? And the answer is yes. The input from the town's financial advisor, capital market advisors, as they presented in August, basically said that the term of a loan for acquisition of a utility is 30 years, not 20. So one of the changes is just the term of the loan. Secondly, to have the first year, bring this thing back up. Look at the chart, the green line is the town, to have 1 year of short-term borrowing at the town's interest rate, again, different from what was being modeled back however many years ago. That's a change. And then I would say what we've consistently done, as requested by first Ted and now Tom Mayo, is to consult with capital market advisors as to what interest rates to use. And I would say, candidly, those would be the three things that I think have changed that have caused that line to be represented as it is, where it's affordable. It meets the criteria that the committee established when it was formed.
And thank you, John. And I know at the meeting that I was at, there was a high-end number in that ballpark. So whether you don't remember saying, it was never public, though, because we were sitting in a room. But it doesn't matter. I appreciate you clarifying. That helps me a lot. My only concern, and I'll end it at that, is back then when I was told what the number was, and we knew it was going to be at the end of the litigation, that it was a $75 million ballpark number. And so I think there's just, in my humble opinion, there's, to me, in the future, there's going to be some uncertainty of what we, the taxpayers, or the ratepayers in this case, but it could overlap at some point, what we'll ultimately have to pay if the models aren't accurate. And so I understand things change over time, maybe for the better, maybe not. But that was my concern, and I was having a hard time understanding why we had kind of transgressed into a higher figure, and now you've given me your explanation. So.
Well, and I would add, Paul, that I think that's from my perspective, the tremendous benefit of what the Board of Selectmen did in retaining two outside expert firms to review. I mean, as you saw from the chart, the numbers changed both from an aquarium as well as a town perspective because they're experts, and Ed and I aren't.
Well, and the last thing I'll say is that I've heard different comments from different sides, and I think everybody has to make their own conclusions based on what they know and what they hear from the committee and also Aquarian. So I just think people, I hope they just make their own decisions up, but I appreciate the explanation. Thank you.
You're welcome. Sir, in the back.
Skylar Thaxter, 246 Main Street, Hingham. First of all, obviously, the work you've done is amazing. And you are comparing Hingham to Aquarian, Hingham Future Company to Aquarian. But then I just heard tonight, as I knew, as someone stated to me, there are a lot of municipalities that have their own water company. So in doing your financial comparison, your government comparison, your engineering comparison, what have you done to compare yourselves, as the schools have to do, in terms of comparing themselves to other towns of comparable size, comparable budgets, everything? What have you done to look at other town budget? For example, maybe we don't compare ourselves to Scituate, but Scituate just voted, what, $20 million to their water company to revamp the water treatment plant, to put in new water mains, everything like that. Boom. I'm talking to people in Scituate. They're not too happy. They're not too happy with brown water either. So what in this process, whether it's the financial or going forward, the governance, have you done to look at other towns of similar size, similar things that have water companies?
We're going to address governance tomorrow night. I think that'll give you a good...
I'm talking financial. Because, you know what, that may not have been your directive from the selectmen, but it certainly would be interesting to see what other town budgets are in terms of operating their company and what they have to have for capital, et cetera. I mean, we're going to be in that business if it looks like you go ahead with this.
We did do that, actually. We've visited for the water supervisor that runs the Hyannis water system, sat down with him. It's a system that's somewhat smaller than Service Area A, and walked through his budget in detail, capital expenditures.
Have we seen that information?
No, we've not posted it just because it's some other towns, but I mean, it's certainly available. It's public. It's in the public
Well,
record.
it'll be interesting to know, because
Sure.
I think that's going to play in. You don't have any examples other than a corporation that's paying people higher salaries and everything, as you've said, and you're going to save all this money. Let's look at what other towns are spending on their companies, on their municipal water plants that are similar to us, so that we know going forward, is this realistic?
Mm-hmm. Right. What we did after an extensive meeting, walking through documents that were associated with studies and acquisitions, that basically we increased our estimate of municipal cost beyond the salaries of the water superintendent, just to accommodate the kinds of costs that were being expended in the Hyannis water system. So we incremented by $100,000. It gets increased 3% every year just to cover the kinds of things that they were incurring, some of which might not be appropriate, but we wanted it to be on the conservative side.
And both Barry Dunn and Anderson Tax looked at Aquarian's operations in New Hampshire and Connecticut as well.
Right.
And looked at their rate structure.
Right.
I understand. That's what I believe they did.
They did, and I'll add to that the equivalent to the Mram capital surcharge that Ms. Kime spoke about last Thursday in New Hampshire and Connecticut, she didn't recall when those capital surcharges were implemented. They were implemented in 2007 and 2009, so they've been in place for at least 10 years in both states. And actually the run rate, the rate increase, annual run rate in both Connecticut and New Hampshire exceeds 4%. So the 3.2% per year that Ed and I were using in our model, the track record, both Aquarian here in Massachusetts for the last 10 years, which is slightly north of 4.0%, 4.1, as well as in Connecticut and New Hampshire, all greater than 3.2%. which goes, I think, Mr. O'Hare, back to your question about why are the numbers so different. Little changes in those interest rate assumption, or that growth rate assumption from a revenue perspective, cause some big swings in a 30-year time frame.
Yeah.
Sir?
Good evening, Mr. Chairman. Richard Pedoni, 12 Newtown Drive, and also counsel to Aquarian. First, I want to thank all of you for your efforts. You've certainly had a long haul and worked very hard on behalf of the town. I'd like to, I have a whole series of questions. I'll leave you with them. You can tell me whether or not you want me to go through all of them. But my first question is with regard to a statement that you made in response to Mr. Lemnios, that rates would remain flat or the same in Hull and Hingham in the entire service area. So one scenario that we may face is that Hull requires significant capital investment. There's no law that says if the capital investment there is significantly higher, Hingham as a provider needs to keep rates flat for Hull. Is the town now making a commitment regardless of the capital required in Hull to keep rates flat or the same rates for all customers?
Yes.
And that would be over the full 30 years?
Yes. By law, I think we've heard, cannot have different rates.
You can have different rates in different communities under the law. So if the law doesn't require it, will the town still determine that that's what it intends to do?
That's the position that we've taken, yes.
Okay. I was happy to see that the town has transitioned to a bottom-up analysis in listening to the Anderson presentation. But a bottom-up analysis requires that the assumptions that you are relying on in the premises be accurate. And I haven't seen anything where the committee has put out any reports or detailed study of a couple of the key assumptions. First, the finance seems to be relying on the CMA presentation that was made. I haven't seen any other study by this committee of finance costs and what they're likely to be. CMA indicated that the town would issue short-term notes to make the purchase, and then it may issue permanent financing over a series of years in multiple tranches using general obligation bonds. My analysis is that it's unprecedented for a community to use general obligation bonds to purchase assets in another community in this way. And so I was wondering, has the committee obtained an analysis of whether this can in fact happen? Does the town have a legal opinion of this issue?
The town has, I know the Office of the Selectmen has consulted with not just capital market advisors, but also bond counsel, and has not come back with the result that you've just stated, that it's very doable what has been proposed about a general obligation bond issued from the town of Hingham.
Can be used to purchase assets in a different community.
Correct.
The presentation by the gentleman from Anderson relied upon information that was given to him that the contract operator, which could be 40% of the cost, he had figures that he used in terms of what that contract operator cost will be. That's approximately, we assume, 40% of the total cost. Does the committee have the contracts or the base information that was given to him, and has it studied the assumptions as far as what is in that contract and the potential variances that could occur?
We received, as a result of the town administrator issuing an RFP back in July, the results of the bids, non-binding responses. So the answer is yes, we took the highest of the responses and used that value in our model. I think, as I recollect, last Thursday, I think Mr. Dondero validated that that seemed a reasonable approach from reputable, experienced vendors.
And has the committee analyzed the scope of work that was part of that response?
Yes, and you'll hear more about that when we talk about engineering next Wednesday.
And then my final question is, in connection with most large purchases of assets, for example, if this was a corporate purchase, there would be a risk analysis done. and the board would be presented with information. Here is where we believe the numbers could come out, but there are chances that the numbers move in one direction or another. Has this committee performed a risk analysis of the potential purchase and where the numbers could move over time, and will that be made public if it's been done?
Ed, do you want to?
Yeah, I'm looking for my sheet here. We've done sensitivity analysis on both the purchase price and interest rates. And, you know, they all fall within the reasonable range of the numbers that Anderson Tax used, the sensitivity analysis. For example, if the purchase price were to go up to 110 million, the sensitivity analysis shows that the impact on the $50 million worth of savings would decrease by about 3.1 million. So we've run it at various numbers, but that's just the one that comes to mind.
Okay, and
so if it goes up from 107 to 110, the drop is about a little over $3 million.
And on the interest rate front, has the possibility of purchasing a hedge been looked at all if the bonds aren't going to be issued for multiple years?
I haven't looked at a hedge, but I've run a sensitivity analysis. It says if the long-term rate goes up by 50 basis points consistently over the 29 years of long-term financing, what the effect of that is, and it's $5 million.
I have a series of other questions. I don't need to take all of the time this evening. If I could present them to you and ask that they be made part of the record and you could consider them and perhaps respond in connection with your recommendation and ahead of taking a vote.
Okay.
May I approach and hand them up?
Certainly. I'll take that. You're welcome.
Before you sit down, can I ask you some questions?
You can.
So I assume you were here for the presentation the other day from Mr. Dondero.
I was.
Mr. Siegfried highlighted some of that discussion as well, and that included Mr. Dondero's observation about some assumptions or some numbers that he concluded that Aquarian had wrong, having to do with depreciation, borrowing rate, treatment of the plant, rent, among other things. Do you guys have any reaction to that? Do you agree, disagree? And if you disagree, can you tell us what you disagree with and why?
So on the particular Aquarian model questions, I'm going to defer to Mr. Walsh and his financial team, and I would not be the one that would be responding if I could.
Okay.
But if you had any other questions on the mechanics or others, I'm happy to take a shot at responding.
That's my question. I don't know if others have other questions.
Okay, thank you, and thank you again for your efforts.
Other questions? Let me just get some new folks here.
Evening. Richard Norman, 3 Chute Avenue. Hello,
Good
John.
evening. Hey, Dick.
Hello, Ed. We have met each other. I have a number of questions. I think for the audience's benefit, I've written a number of letters, made some submissions, had some discussions with the study committee. This is not a forum in which you can go into a lot of the detail that we've talked about, but I do have a number of questions. I was out of town last week. I've been unable to see the Anderson study, and so my first question is, if you could put back up the slide, I'd like to know, because I have been questioning the apples and oranges basis of the comparison of financial projections, particularly with regard to whether or not there's a concurrent allowance for capital expenditures on the part of the town, which is $2 million over 30 years on the basis of your financial projection, and the burden that has been included in the projected Aquarian rates over that same period of time. I've had trouble hearing and understanding some of the things that have been said tonight, and I point not to this, but there was another slide, Anderson slide, which talked about the, no.
Which one looks good? This
There you
one?
go.
Okay.
So in that slide, you're talking about $2 million of allowance, which is what was anticipated that the town would be borrowing in each year during the 30-year period. And you get out to the Anderson and out, well, and that projects $2 million, a total of $5 million in 2019. The Anderson model talks about the Aquarian plan through 2022 and then 5% in every 3 years thereafter. What does that, is there a slide, or do you have access to a calculation that clearly shows the total number of dollars of capital that Aquarian would be required to expend in order to justify the rates that are included in this projection as compared to the very plain $60 million that is included in the town forecast?
Why don't I answer at a high level, and then, Ed, you can fill in. What we all heard...
Yeah, I'm having trouble with the fidelity.
Okay, sorry. What we all heard for the first time last Thursday, so we were not in receipt of that analysis until last Thursday, was that Mr. Dundaro of Anderson Tax modified the capital expenditure assumption in the town's model. It basically, as he indicates in that third column, used the 5-year capital plan that had been presented by Mr. Walsh on August 13th in some presentation, and then took that value, which I think is 3 years at $2.7 million, starting in 2019, and then 3 years, I guess, at 2.5, and then upped that value by 5% every 3 years, and upped the interest rate under which that money would be borrowed by 25 basis points every 3 years.
I'm not concerned about the interest rate, and you know, I'm struggling tonight because this is not an easy thing to talk about, but we understand utility rate making, and utility rate making is such that in order for the utility to maintain a constant rate base, it has depreciation. It must reinvest an equivalent amount of dollars every year or every 3 years in order to maintain a constant rate base. Aquarian's rate base that was approved is about $38 million. They, as a matter of course, have been investing about $1.9 million of capital. The MRAM that you talk about, which you're presenting in my mind in a very, very unfavorable and I think very, not a very realistic way. You can say MRAM is operating for the benefit of the ratepayers in the sense that it's accelerating capital expenses, that it will be required, that it will be allowed to recover when they file a rate case. So the simple advantage to MRAM is the fact that they get to start collecting on that 2 years earlier, and it is a benefit for Aquarian. But you're also getting an accelerated capital program, which has been taken into account apparently through 2022. But it's the period thereafter where I still am not sure that you have a fair apples-to-apples comparison with regard to the $2 million that the town is expending as compared to the fact that Aquarian in their whole system is spending about $1.9 million just to maintain its rate base without any increase. So it's an open question. I don't think this slide answers it. And I put that to you again. I had it in a letter in September and October. I still don't think there's a clear answer to that question as to whether there's a fair comparison. So I'll leave it at that.
Can I just try and, I just want to try to understand what you're saying on that last part. Are you saying that, you know, for the necessary base, they're going to put in $1.9 million a year, and then with MRAM, they're going to be putting more
Yes.
in on top of the $1.9 million?
And therefore, if in fact they're normal, in order to maintain the rate base, they are already making a capital expenditure and make another $1 million as an example, then the town borrowing $2 million will result in less capital being invested into the water company than you would otherwise have. So at the end of 30 years, If there isn't a fair comparison, you may have a water system where you've invested $60 million over 30 years under town ownership, but the rates that have been projected by Aquarian may have required them to invest $80 or $90 or $100 million. I don't know the answer, and it was in my letter. I never got a response to it in September, and I still have that question.
I'm going to make a couple of observations. One,
I'm sorry, I just want to, I'm sorry, I'm being a pain, but I just want to, but Mr. Dendaro did not take Mram into account in his analysis, so why isn't it apples to apples if we're just using the 2 million plus, plus, plus?
Well,
so we may end up, so to that point, that maybe the town decides they need to do more than 2 million, and then there may have to be a rate increase that's comparable with MRAP. Let's take that hypothetical. But it would still, Mr. Dendaro's analysis would still be appropriate.
I'm at a significant disadvantage because, like a lot of other people, I was out of town. I haven't had a chance to see to look at the Anderson analysis. Ed and John know I've looked at their financial analysis in a lot of detail. And so that's a question I'm posing. Mm-hmm. I put it in a letter in September, which I never got an answer to. And that's the same question, and I'm saying, is that still an issue with regard to the rate comparisons from 2022 on?
I'd make two observations, Dick. One is that what I heard last Thursday night repeatedly from Mr. Dondero of Anderson Tax was that the capital number that he used in the modified version of the Aquarian model was the Aquarian capital number that then got the Aquarian 5-year capital plan that got incremented. So the town's assumptions in the July model, he modified. Secondly, I'd make the point that the Aquarian 5-year capital plan, I believe, addresses Aquarian of Massachusetts. I'm not sure about that. But so it's also Oxford and Millbury, potentially, not just Hingham, relative to the magnitude of the capital investment. So I guess all I would say is that relative to what I think I heard last Thursday, and you'll judge for yourself when you get a chance to see the YouTube recording, our assumption that we'd used for many years got modified when Anderson Tax's expert went in and basically used Aquarian's 5-year capital plan as a starting point for CapEx. What he didn't do, as Ed said, was to factor MRAM in, because I think in response to a question from Josh, he said, it doesn't matter if it's MRAM or not. He's just wanting to make sure that the capital expenditure from the town and the capital expenditure in the bottoms-up model that he did that modified the Aquarian were equal.
Okay. Well, I question whether $2 million a year will give you the same capital improvements under the town's financial plan as the burden that is shown with Aquarian. And I don't want to belabor. I belabored it too much already. There was an issue raised by Mr. Gannon, and I would have given a very direct answer, and that is that there was a public statement that the town could not afford more than $75 million. That was Mr. Lexiotis who did that. I think we all know that the way the town is now affording $112 million is that the term of the debt has been increased from 20 to 30 years. If you had 20-year debt, the amortization cost of that debt would be unaffordable as compared to Aquarian rates. That's the real honest answer, is it not?
I can't dispute that. I think you've made the statement, and I would agree with it, that as capital market advisors also said to us, to have a longer term also it more fairly addresses the ratepayers so that it isn't all front-end loaded, and there are people in years 21 through 30 who are basically getting a free ride financially. So there are, I think, multiple motivations for that.
Well, I mean, the related question is, with 30-year debt, and this is another topic where I have a disagreement with the plan that you have, is you've got level principal debt. So what's the first year level payment?
No.
You're going? Thank you.
Yeah.
You're welcome.
That's what Anderson Tax did, basically based it on level payment.
But I believe I said that tonight.
Big improvement. Okay. Another question which I have is, what is the assumed timing with regard to closing on the financial debt, taking into consideration that if the town vote occurs in April, how long it's going to take to arrange for closing on your financial debt, together with the overlap, and we get into governance and operations, the town is just not going to start operating the plant the next day. So what's a reasonable assumed closing date with regard to assumed closing date?
Right. We've addressed that with capital market advisors, bond counsel, also the town treasurer collector, Tom Mayo, and the word we were hearing was anywhere between 6 and 8 weeks. It's certainly a couple of months. It's definitely not the day after town meeting. So you're right. There's a lag there, during which, as the DPU pointed out in its October 31 order, Aquarian would be obligated to exercise good husbandry in the continued operations and maintenance of the water system.
Okay. The next question which I have is, I've attended one of the neighborhood meetings. I'm not sure how many other people have. Many people have. They walked away thinking $136 million of savings. There's now projected to be about $50 million of savings. But there still is a question, because you do not have concurrence with Aquarian or any opportunity, as an earlier speaker has said, to basically address what those differences are. Is there any, I gather there is not going to be any intent to basically identify, and even if you don't sit down with them, respond in some fashion rather than just point to the Anderson report?
We just asked them to come up to speak. We just asked them to come up to speak. If they have concerns, okay, I want to hear it.
Okay.
And I'm sure we all want to hear it.
But I would also say, I thought Jim Dondero last Thursday walked through in pretty good detail the changes that resulted in the difference in his projection of town savings. I mean, he didn't just put the number up there. He walked through what the ingredients were that he modified when he basically modified the Aquarian model. So I came away with a pretty good understanding of why the difference.
So my final question is, the last formal meeting I think you had, other than last week, was a year ago. The first time that there was a financial projection put forward in detail was when you gave an update to the selectmen in late 2018. You had a very detailed financial model. It was made public and people could look at it. There have been a lot of changes in terms of what's led to the graph which you have up there. Are you intending to provide a similar model, make it available to the public, and is that going to be the basis of the vote that you intend to take next week? Because, to be very honest, I know you spent a lot of time. I still am at a point where I think the town can provide a way in which to effectively acquire the water company. But, you know, I disagree with governance. I disagree with operations. I think financially is a big step with which you've taken with regard to level payments. But when you take a look at the financial commitment that's needed by this town to have a meeting tonight with this number of citizens, and then to talk about a vote next week on a financial commitment of $180 million or $240 million, I just think it's inappropriate for a committee not to afford some further opportunity for the public, and I think you need to have a record of exactly what it is that you're going to vote on and approve, and I think it ought to be in the same form that you provided to the selectmen late in 2018.
Okay.
Thank you.
Thank you. Other questions? Mr. Walsh, your name's been mentioned.
Good evening. John Walsh, Vice President of Operations for Aquarian. So first, to answer Mr. Krumholtz's question, or questions regarding our financial folks' comments on the report or the model. I should clarify that all that's been presented so far is a PowerPoint slide, and so I hear people talking about a report. So I'm going to second what Mr. Norman said. In July, you posted your model in detail, an Excel version of it, a PDF version of it. You gave a Q&A. You put your PowerPoint presentation up there. It's all still on the website. It would be great to get that same level of detail, and that's what we could respond on. Because if you can understand, our financial folks are looking at a PowerPoint. There's a couple data points in there, but you guys have looked at these models. That is not enough it's not enough to fully understand what he's put in the model.
I would just correct you, John. Ed and I, none of the committee members have seen the model.
No, we haven't seen the model.
How come you guys haven't seen the model?
The expert reviews were arranged out of the Office of the Selectmen. We were kept separate from the reviews so that there wouldn't be any intimation that we somehow tainted the outcome.
The first time we saw Dondaro's report was Thursday evening.
Right.
But the report, so there's a report.
Well,
the PowerPoint that he presented.
His comments and the PowerPoint presentation.
Definitely, I mean, when I hear report, I think of a document.
Oh, no, it's the PowerPoint that he presented.
But now that he's presented it, I'm assuming that you have seen it.
The model? The model?
Yeah.
No.
We don't have the model. I think, John, your question is better posed to Tom Mayo, who really arranged the expert reviews. We played no part in that.
Okay. Well, for us to be able to comment on the model, we would need to actually see it. Mm-hmm. And so I am going to safely assume that not only Aquarian, but the community is going to be able to see that model. That's important. The 50 million suggested savings are based on a model, apparently, that very few people have seen, including yourselves.
Correct.
Okay. Just I wanted to follow up at some of the discussions about capital. So just to clarify, over the last 5 years, Aquarian has spent an average of $2.7 million a year on infrastructure investment in this water system. Mm-hmm. In our current 5-year capital plan, starting in 2019, it's $22 million over the 5 years. So that comes out to $4.4 million each year. That difference between the 2.7 historical and the 4.4 a year moving forward, and again, it's an average over those 5 years, that is an impact of the MRAM. That's, we put together, I think Mr. Siegfried can appreciate it, we put together a significant study, determined that there was a need to accelerate investment so that future generations didn't bear the brunt of replacement of the infrastructure. We put a proposal together based on that, presented that proposal to the Department of Public Utility early in 2018, argued for that proposal in front of attorneys from your town and Hull and the Attorney General's office and the Department of Public Utilities. The end result was that they accepted our proposal to accelerate capital investment, which I think is all good for the communities.
Can I ask a question, John?
Sure.
With MRAM, my assumption in the review of the testimony that was submitted in support of the amendment, the amended filing, was that the Mram surcharge would encompass capital improvements both in Service Area A and Service Area B.
Correct.
Is that correct?
That is correct.
Which is very similar to how rates are administered across according to Massachusetts, shared between Service Area A and Service Area B.
Yeah, and I'm sorry, and now I understand it's hard to hear you.
I'm sorry.
Because you're coming out of the speaker in the back of the room, I think.
Sorry. Relative to that, is it the case that the water treatment plant charges, the surcharge that's applied to Service Area A bills, is it the case that those charges, that those charges are shared with Service Area B. I think Service Area A pays for some of Service Area B's water treatment and purification. Is it the case that Service Area B pays for some of ours?
No, the treatment plant here in Hingham, serving the 3 towns here, was a unprecedented expenditure by the prior owner of the system back in the mid-90s. And the decision at that point in time was to carve it out from the rest of the company and add it as a surcharge to the bill for Hingham and Hull customers.
The DPU rate order acknowledged that discrepancy or that, say, lack of sharing, and I guess my question would be, why has it taken 20-something years to acknowledge a problem that still hasn't been fixed? In other words, Service Area A folks are paying for the entire cost of the water treatment plant, as well as some of the water treatment purification and in Service Area B.
It's very limited in terms of dollar volume of water purification in Service Area B. And Service Area A, Hingham and Hull expenditures, folks in Service Area B, they pay for those along with all the customers here. So there's, hopefully that's clear, expenditures in Service Area B, those capital expenditures, capital expenditures in Service Area A, Hingham and Hull, all of our customers in the state pay for those.
Yep, that I get. It's the water treatment plant that I'm...
Yeah, it's the water treatment plant that was carved out at the time,
right,
because it was so expensive. And it drove the rates in the system.
Right. In other words, if those costs had been shared, as everything else is shared, including the proposed, now approved MRAM, it would be the case that the base rate increase in Service Area A would be lower, potentially?
I'm not sure. Actually, the percent rate increase for Hingham and Hull residents was lower than the percent rate increase for
I just meant
Area B.
Absolutely looking at Service Area A, would it in fact have been lower just because the costs were being shared with Service Area B?
I'm not sure I'm following. I know
That's okay.
You mean the absolute rate?
Yeah.
Yeah. John, can I ask you a question?
Sure.
When does the water treatment plant lease end?
Off the top of my head, I don't know. It's actually in, you know what, I think it shows on the graph here.
2035?
At least in Anderson's model, that drop, and it must be 2035, 2036.
It ends in December 31, 2035, according to the lease. But the Aquarian model that you presented in October shows it ending in 2036. I'm just wondering why it went 1 year beyond the expiration of the lease document.
I don't know the answer to that.
Okay, you might want to look into that.
Yeah. Well, this gets to my next question. So, Mr. Siegfried, as you were going through the numbers,
sure,
I'm familiar with some of them, and even I get lost on a lot of the numbers, and I'm not the financial guy. And you've heard other people tonight, and we've been saying it since August. There is real value in having an independent third party look at this. I think there's value for you, and for the community, definitely. And your, or the town's consultants did their work in about a month. That could be done in about a month. So my question to you is, why doesn't this committee recommend next week that there be a third-party review? Can your recommendation be that there be an independent third-party review? It would address this back and forth, and I've talked about this in some of our public forums. We're spending a lot of time with the dueling financial models, and I think it would make sense to everyone to see if we can find an independent third party who can look at it.
I think we found one. And unless somebody is going to say that this person somehow did not take this task on independently and have full authority to come up with whatever conclusions he deemed appropriate, I think it's inappropriate to suggest that this person was somehow biased.
Did I suggest that?
Well, you're suggesting that we need another one done because...
What I said, now you're putting words in my mouth, and I don't appreciate that.
What is wrong with this person?
I want to make clear, you just put words in my mouth.
Let's take it easy.
Yep, everybody back down a little bit.
unless they're, I mean, timing obviously matters with town meeting coming up, where everybody is already under the gun, as it were. Delaying a month would be very problematic to the process. Unless and until, and if people have reason to believe that this person has not done an objective, unbiased, fair analysis, which people can agree or disagree with aspects of that analysis, and I'm happy to hear it, but unless somebody's going to point to something, I don't get it. I don't get why we would have something else done again.
I just heard you say an interesting thing, under the gun. Some of the folks we hear in the community are saying a similar thing, which is there's a rush to judgment here. And, well, you just said under the gun.
Yeah, because timing is tight, but, you know, if there are reasons that things can't get done, then fine. But, you know, just to delay for the sake of delaying doesn't make a lot of sense to me. Let me ask you a question.
Sure.
Can you put up the slide?
Sure. Which one are we putting up here?
Well, it was, I guess it's 14, actually, on yours.
Okay. So it's the assumptions, okay.
I hear what you're saying about not having the model, but I'm sure you have spent the last several days with your financial people looking at, you know, the comments made by Mr. Dondero on this. Actually, I want the previous one. Yeah, I mean, it's both of these pages. You know, one that has stuck out to me in particular is that bottom one, where he concluded that in Aquarian's analysis, you guys used the town's borrowing rate rather than what presumably would be your borrowing rate, and he identified that as one of the big ticket items.
Yeah, what we
do you have
used
any
in our
reaction
model,
to that?
What we used in our model was your assumptions plus 50 basis points. So I'm not the financial person, but the 3.75 was applied, I believe, to your purchasing debt, and 3.25 on your continuing annual.
Correct.
So we took that 3.25, we put 50 basis points on top of that. So is that clear? That 3.75, that's your purchasing. That's
right.
Your interest rate in your purchasing.
But he's suggesting that you were using that in the model for your costs.
But we took what you used 3.25% for your ongoing $2 million a year borrowing for capital investment.
Right.
We added 50 basis points to that.
But why didn't you use, 4.88, which is your prevailing rate?
Because our advisors have told me 50 basis points on top of what the town, or a 50 basis point spread is an appropriate spread for our rating versus your rating.
For 10-year borrowing, right?
I'm not the financial guy, so I don't know all those details. But so that is why our folks use 50 basis points on top of your borrowing rate that you assumed.
My recollection, Josh, is that Mr. Dondero did acknowledge the delta, but then said that was for 10-year borrowing, right, and extended it beyond that to get to the 4.88 over 30 years.
Okay.
Or 29.
So one question I have about the presentation last week. So the capital spending plan that your consultant indicated that he reviewed doesn't match your financial model that you presented back in July. And can you explain why someone changed that capital spending plan from what you showed to the community in your model in July to what was given to the consultant to review? It sounded, it's on a slide here, but it sounded, or not it sounded, he was saying that there was a different capital investment summary than you have in your model in July.
That's correct, but we didn't change it. He changed it. I mean, you said, did we change? We didn't change anything. We haven't seen his model. He, I think, started, as he described Thursday, looking at the Aquarian model and making modifications to it that he thought were appropriate. And I think in the spirit of that, that's why I'm kind of interpreting that's why he used your August 13th, 2018 5-year capital plan as the basis for the CapEx that he included, which was, as I think been pointed out a couple of times tonight, greater than what we built into our model. Then added, which we certainly didn't have in the July model, the assumption of an inflation adjustment every 3 years and of a borrowing rate increase every 3 years for the capital replenishment.
You know, that's an important point to, I think, some people, that you just acknowledged something, and I very much appreciate you acknowledged it, that you didn't have that inflator in the CapEx. And, you know, what we heard last week was that there was a difference and that the town was going to be investing more than Aquarion. And I don't think it's necessary to, and you just acknowledged that you didn't have that inflator in there.
That's correct.
Yeah. Is it?
We're using, I mean, he used your capital plan, which he said was greater, and again, goes back to a couple of the observations made earlier this evening. I think that's one of the reasons of the difference between the 136 million and the 50 million. We heard that too.
On that point, I mean, what we were hoping is that there was actually a model, a report that enumerated, that showed where that $90 million difference in savings came from. You know, whether it's capital, or something related to our taxes, or something related to our debt. And it sounds like there isn't a report, so there's no enumeration of where that 90 million came from.
He walked through, I mean, again, I think that's the point of that slide right there. It's more than capital. He made changes in the inflation rate assumption. He made changes in the borrowing rate assumption. He made changes in the capital, both in terms of amount as well as the increase for inflation, the borrowing rate for the capital replacement. I mean, there were a number of modifications.
But what would be great, you know, I can say this, in the business world, if you went back to your bosses and you said you made a $90 million, you know, that the savings changed by $90 million, I can assure you you'd be asked for an enumeration, a listing of what caused those changes. So that is what I'm wondering. Is that available?
How is it not that?
Well, I don't see something that says CapEx, 40 million of it.
Oh, I see.
Debt, Aquarion tax assumption, $10 million of it. Aquarion debt assumptions, $5 million.
In other words, detail that's more specific than that?
I think you said
No, a list that bottoms out at $90 million. That says,
I think he's
from the original,
you know, the number, you know, what the dollar amount, another column that has the dollar amount attached to it. That's basically, I think, what you're saying.
Again, without trying to deflect your question, I would just say we didn't play a role in the retention of the expert firms. That question really should be posed to Tom Mayo, the town administrator who did that work.
All right, we will ask him for that. So, all right, well, you have any more questions for me? All right, thank you, guys.
Thank you.
Thank you.
Other questions? Mr. Taylor.
Hi, Jim Taylor, 3 Gristmill Lane. First of all, thank you all for your hard-earned hours and effort into this. It's a very complicated situation. While it may feel rushed today, it's been really a 6-year, 7-year project. And so we're just getting to the point now, and it's been a lot of work to get here. But I wanted to bring up, would you mind bringing up a slide, John?
Sure.
And that is the slide, the next slide, please. So as I was reviewing your financial experts' analysis, I was struck by a couple things. The first was the town made a 30-year projection around your costs. The financial analysts did the same and made the same projections. And I was really struck by the fact that his final analysis showed only a 3% difference between the town's projected costs and the Anderson model, which is really kind of amazing when you think about a 30-year projection. But what I was really struck by, though, was the Aquarian difference. If you look at their projected costs over 30 years, they projected a $470 million cost. Utilizing Anderson's analysis, they believe that Aquarian underestimated their costs by $106 million over those same 30 years, which is a 20% difference. I really think that's very significant that they dramatically, according to Anderson, underestimated their costs. And I really believe it's due to a couple different really analysis points or variables. If you go back, if you don't mind.
Sure.
If you go back to right there. Aquarian in their model used an inflation rate of 2.2%, which in my opinion is a very low rate and a very low expectation of future expense rates. I don't think it was reasonable. And what Anderson did is they equalized it. And I think what I heard from Dondero was he said, it doesn't matter who's spending and whose cost it is, that rate of increase is going to be the same for either the town or for Aquarian. So I think that's an appropriate way to look at it, and that's really driven, I believe, Aquarian's cost differential. And the second is the interest rates. And this is what really bothers me, is that Aquarian used, and I heard from John, and I actually talked to Aquarian about this in a September meeting that they had. The 50 basis points difference is incredibly understating the difference in the market between what a corporate issuer would have to pay and what a municipality. And it's very readily available information. And in fact, today the difference between Eversource rates and what the town would borrow at is about 2%. Not 0.5%, but about 2%. So I'd almost argue that Dondero actually underestimated the difference between in the bond valuation. I went up to Aquarian following their presentation, bringing that point up, that it's very, very available information, and it fell on deaf ears. They wouldn't look or change the model. So again, I was very disappointed that they never updated it, and I'm glad to see that that Anderson actually equalized it. So those are actually my two comments. Again, thanks for all your work and your effort.
Thank you. Other questions? Ma'am? You've been very patient.
Pull this out there. Thank you again, Polly Rowe, Hall resident. I have three comments, like statements to make to you, but they will culminate in a question that I have for the board. Number one, I have been through an extensive, should we say, legal experience, not of my making, in years past. And I would have loved to have been able to mandate that everybody in that legal scenario who got the same exact benefit as I did had to share in the legal costs. My point is, as a Hull resident, from the first time I heard a long time ago, I think it was from one of the selectmen or selectwomen, that all the ratepayers will be absorbing the cost of Hingham's litigation fees of $1.5 million plus. I personally failed to see the equity in that. It was Hingham's choice, Hingham's decision. I don't know where the equity is for the other towns' ratepayers. That's one comment. The second comment, in respect for our town manager, who I think has left, Phil Lemnios, as a citizen, I share a different perspective, and in some places disagree with him. I believe I heard him use the word transparency. And my gut thought was, as a citizen, I have experienced zero transparency. When I talked to various Hull residents, there were many Hull residents who are extraordinarily concerned and afraid about this, and particularly because Hull and Cohasset do not have a vote in this. And every time we've asked in any context, whether it's Aquarian forums to town officials, in Hingham meetings we've come to for information, nobody's getting any information. We, at one of the Aquarium forums, I believe it was in November of 2018, a couple of our select people were there, selectmen, selectwomen, and the mention had been made that an invitation had been put out to Hingham officials to come to Hull to share information. That still hasn't happened. I don't know when it's going to happen. My point is, when I hear the word transparency, it does not resonate with me, whether it's any Hingham meeting or otherwise. And when I talk to my Hingham friends, they say the same thing. We're not getting any information either. So, and so that's for those of us who are trying to pay attention and follow and wrap our minds around all of this, much less the many Hingham people who are going to vote who aren't probably paying attention. So, the last and the most important thing, and I find this really bothersome as a Hull ratepayer, when I heard our town manager talking about it's going to be wonderful that we all are going to own our own municipal system, I thought, Hingham's going to own it. Hull comprises 36% of the total ratepayers. We are, according to my understanding, going to be paying approximately $60 million over the course of 30 years into this. For that, as far as my understanding goes to date, we will get zero benefits. We get 0% of any if there's profit to be made with the Hingham developments and whatever else may be going on. We will get 0% of that. We will have zero input into the decision-making and the rate setting. We'll get one seat on the advisory board, which is not the same as being able to vote and set rates and so forth. So my question is, what equity will Hull residents get if the town does decide to buy Aquarium?
How do you define equity? I'm not fencing, I'm just not sure what you mean by that.
Well, I'm referencing Town Manager Phil Lemnios' comments that all the ratepayers are going to have equity in the system because you're now going to own it. And I thought, no, Hingham is going to own it. We won't have any equity. It's kind of like I'm going to be, or Hull and Cohasset are going to be paying rent into Hingham's mortgage to own this. So we will be paying $60 million over 30 years with no say-so in any decision-making. We don't, after 30 years, we don't say, well, gee, we own 36% of the Hingham water system. We don't have, bottom line, we don't, I'm thinking of a homeowner, you know, when I pay my mortgage, I can say, whew, now I own, you know, X percentage of, you know, the principal in my home. After all the years of Hull residents paying into Hingham's ownership of this, what equity, what will we have to show for it? I don't see that we will have anything to show for it in terms of ownership or benefiting, as I say. Maybe there will be some profit to be made from all the developments that are going on in Hingham. That's how I'm seeing equity. If I'm paying into your figurative mortgage, after a certain time, I'm like, gee, I should be owning a third of it. That's what I see equity as. Could you please address that?
I would just say, I don't want to speak for Mr. Lemnios, but tomorrow night is the presentation on governance, which I think would address some of the points that you're making. And
I guess, John, the other point to make is we are bound by the statute under which we are exercising our right to purchase. And that statute says that the town of Hingham needs to be the sole owner after the purchase is made. So we're bound by that.
Okay, and I understand that and I respect that, but just when I heard the term equity mentioned, and congratulations because everybody will own it, and I thought, no, everybody won't own it. Hull and Cohasset or North Cohasset will be paying into it, but we don't have any ownership in it. Hingham will be owning it. So if at some point, for example, you know, you say, wow, we paid it off, we're making great profit, maybe we're going to turn around and sell it, I don't know, whatever. It doesn't seem like we're getting anything for what we're paying into it.
Yeah,
from an equity
standpoint. I would
standpoint.
just say, I don't think anyone here in this committee said that the ratepayers would be receiving equity.
No, I heard it referenced in our town manager's comment, so that raised the issue in my mind. All right, thank you.
Certainly. Other questions, I guess? Dick?
Thank you.
Certainly.
This will be very brief. Thank you. I found an answer to one of the issues,
Okay.
which was a slide that came up, apples to apples, 2020, 2048, which shows the CapEx.
This one?
Yeah, and it's the third line up, showing the town at 2007, or 2.7 million, Aquarian 2.7, and then in 2048, 3.69.
Right.
So there must be in the model, you know, either a cash flow statement or something that indicates what those totals are. So the narrower question which I would ask is, the original model that you presented to the selectmen anticipated that there'd be a need to borrow $2 million a year. And to the extent that you're going to change your projection, it would seem to me, I now understand also, I think they've taken a number, 2 million, and just escalated it at 5% per year over that period of time. So I think it would follow that in order to fund those capital expenses, the projection that you showed last year needs to reflect not a borrowing of $2 million a year for the 20-year period, but rather whatever the escalated numbers are, which I think will show a much higher debt commitment on the part of Hingham in order to fund the capital.
Right, and I think that's what we heard last Thursday night.
He's reflected in the model.
Yeah.
Well, so there is, well, it's reflected in this model.
Yeah.
Right.
But is there a model prepared by the committee, or are you going to use the Anderson model?
Yeah, I think Ed and I, as of last Thursday night, got out of the model.
We're out of the modeling business.
When the experts spoke.
No, we're out of the modeling business.
We're,
Okay, yeah.
when the I mean, we're not going to sit and tell the managing director of Anderson Tax Valuation that we can model better than.
I'm not suggesting that, but what I am suggesting is that if you're going to take a vote on a financial plan, and that financial plan shows an initial borrowing of 112 or 115 million, and then show a concurrent obligation during the course of the 30-year period, where the only way that you can economically fund the capital expenses without adding them year by year by year is to put in the 20-year debt that you've assumed. And therefore, the amount of debt that's going to be needed in each year of the borrowing will be something other than will be higher than $2 million to fund this.
Yeah. Correct.
And therefore, if I were to speak before town meeting and talk about an impact with regard to the borrowing obligation to be incurred by the town in order to do this, right now, the answer is $60 million.
Yeah.
My suggestion is, my belief is, that if you make that adjustment, you're going to be seeing a much higher borrowing commitment over the 20 or 30-year period in which it operates. And I want to, you know, if any, I always get very uptight when I'm speaking. I don't mean to speak from a negative point of view, because as I've indicated before, I think there's a way that the town can craft a purchase proposal. And I think you've taken a big step with regard to changing the form of debt. And, you know, that's something which freed up a lot of cash flow capability in the early years, and it explained to me when I looked at the rate projections without understanding that you were using level payment, I couldn't understand how you could get to the numbers that you do. Now I understand that.
Right.
Thank you.
Sure.
Thanks, Dick.
Okay, sir, come up and identify yourself, please.
Hi, I'm Ted Matthews, 102 Hersey Street, and I think Jim had a good point. I think this gentleman had a nice point too, in that it takes the borrowing and the interest on the purchase price from 112 to about 185. Then that additional 60 is probably going to end up being 90. So you're looking at potentially $250 million for this borrowing over time, where we have Foster School, the fire department, the library, the teachers' salaries, the police and the fire, and an unfunded pension liability to worry about. So I just think that this water company purchase is a folly, and we ought to pass on it.
But I just want to clarify a point that I think both Ed and I have made tonight. The borrowing that would be done to acquire the water company if town meeting so voted is separate from property tax escalation that would occur with any one of the projects that you've referenced. It's totally funded by ratepayers. And in fact, the debt that would be incurred, what we've heard from capital market advisors, doesn't count, because it's a utility, against the town's burdened debt. I'm sure I'm not using the right terminology.
Okay, I have heard that as well. However, I think the savings gets eroded and that the taxpayers are on the hook after that point. So there could be a point where if the water company is not making enough money, that the taxpayers have to pick up the difference. If you follow me?
I guess, well, the thing I would say is that, like Hingham Light, the water company, if the town voted to acquire, would be in an enterprise fund. The money doesn't go anyplace else other than within the water system. And so I guess the question would be, is it really realistic to assume that people will stop using water to the extent that there's not a sufficient ratepayer fund flow to cover the costs? I think we could all debate that, but unlike some other services where you can get an alternative source, I would say not likely with water systems, in my opinion.
Right. The light company just raised our rates about 15% 6 or 8 months ago. The water company could do the same thing if they ran into the same problem, not being as profitable as they had hoped to be. Mm-hmm. Correct?
The water commissioners, right, with the input from the customer advisory board, I guess, that Josh will talk about tomorrow night. Yeah, the rate setting and capital investment decisions would be made, and also with input from the water superintendent.
You also used the term profit, and really there's nothing in the models that indicates that the water company's obligated to return a profit. Same thing with the electric company. They're not turning a profit. It's a cost-based business, and they're passing the costs on to the ratepayers with no profit, unlike a private sector company that is obligated to earn a profit.
And just kind of along those lines, if there is some event, down the road that requires some additional expenditure, that's going to be borne by the users no matter who owns
it.
That's just going to be an additional cost, and it's going to end up in the rates regardless.
Okay. All right. Thank you.
Thank you. Sir.
Jim O'Hare, 11 Heron Way, and I also was present at the August meeting when the financial advisor made that statement. And one thing that I did find that I was highly suspicious of was the fact that they asserted that, just as you had said, that there would be no change in the AAA rating. I think that is correct, but I think what will happen if there's another $115 million on top of the $68.2 million that currently is outstanding on the town debt, it will be a general obligation bond, and if not in the first year, and I don't think they probably will do it in the first year, but in subsequent years, they'll put an addendum in there so that people purchasing GO bonds of Hingham, which presumably continue to be AAA, I agree with that, there will be a notation that the debt has increased significantly, and that will be something, I think, just off the top of my head, of approximately 236%. The other thing that I'd like to point out is that yes, the Anderson model does do $50 million, and on a 30-year basis, that's about $1.7 million, and then I think I'm correct in the town's budget last year was $105 million. It'll be substantially more because of inflation and increasing costs. That's not a big, to my way of thinking, that's not an enormous savings on an annual basis to merit the transition. And to think, from my experience in the financial business, to assume a new company in 6 to 8 weeks is absolutely unbelievable. Most corporations take 3 months, 4 months, and sometimes almost a year. Mm-hmm. unless they have everything in line right now, new management, new operations and maintenance contracts in order, to negotiate those is a prolonged process. It's a big bids, and if they don't do it that way, they're going to get taken to the cleaners. So that it's going to be a long time. By the time the vote is taken and the completion of this deal, there's a big spread there.
I wouldn't dispute that. The question that I was answering with the 6 to 8 week time frame was relative to the financial transaction only, not the turnover in terms of operations and maintenance.
Well, that financial transaction won't culminate or take place until the deal is completed, and that can't get completed until no one will go along with that deal until they have all the contracts in place.
Right.
So it'll be a while.
Mr. Walsh.
I just want to add clarification on a comment that I just heard, that no matter who owns the system, the customers pay all the cost. First of all, in between our rate cases, in the last rate case it was 6 years in between our rate cases, if our costs increase or there's a big cost that we weren't expecting, Aquarian pays that cost. Our customers do not pay that cost. If we have a cost in year 2 after we have a rate case, big cost, and we don't have another general rate case for a couple more years, customers will never pay that cost. So it is different from the town. If I understand an enterprise fund, every year the town has to square that up. I believe it has to go in the town's budget showing, I'm not an expert on this, but I think it's got to go in the town budget with your projected income for the next fiscal year and your projected expenditures. And if there's a difference there, if the income doesn't cover the expenditures, then the remainder goes on the tax levy. But my assumption is that what the town will do is just raise rates to cover. You have to cover your cost. My understanding of an enterprise fund is that's how it works. That is not how it works with a private company. In between rate cases, as costs go up, or if there is a big cost, that comes out of our pocket entirely, every dollar. And the other night, I heard a question from somebody and an answer from your consultant. The question was if something goes wrong, and I don't remember the exact words, but if there's a fine or something like that. And I think the answer was that someone gave was that no matter what, the ratepayers pay it. That is not the case. It is highly, highly unlikely that if Aquarian makes a mistake and we get a big fine, that our regulator, our rate regulator, would ever allow us to have our customers pay for it. There is absolutely a difference, and I want people to understand that. You should look into enterprise funds, understand how they work. Someone covers all that cost. And every year, my understanding is it has to be adjusted so that cost is covered.
Good. Thank you. Yes, sir.
Richard Pedoni, 12 Newtown Drive. I'll be very brief. Do you know if the model that was put forward the other evening covers transition costs? So there'll be a town meeting vote, it will take place 1 month, 6 months, 3 months later, there'll be a closing, and then there'll be transition, a period of time when revenue is not yet coming to the town, perhaps. Is that cost in the logistics of a transition built into the town's model?
Into the experts model?
Yes, in the town's model, the town will be presenting at town meeting. Are they accounting for those transition costs?
The model that Ed and I developed did. I can't speak to whether or not the Anderson tax model does. My assumption would be reviewed our model and incorporated those costs, but that's an assumption. I don't know.
Okay, and what were your transition costs and how did you arrive at them?
Probably up north of $300,000 for all kinds of things. I don't recollect right offhand. I haven't looked at the model in a while, but fairly significant over and above the labor costs associated with the water superintendent and the administrative support. So there were ongoing municipal costs and transition costs that were in the model. modified after the July posting, as a result, really, of our discussions, as I mentioned earlier, with the water superintendent or water supervisor of the Hyannis water system.
And did you have borrowing calculations for the period of time before the town will actually begin to receive revenue to cover operations during that period?
No, we didn't get into cash flow.
And do you know if the town's model accounts for covering expenses before it begins collecting revenue?
When you say town model, again, you mean Anderson's model?
Anderson's model, or whatever model you will be basing your decision on. So we're going to have a closing. Right. The town will own the water company, and there will be a lag before the town receives funds to pay the water commissioner day one, pay the contract operator, buy the chemicals, maintain the plant, deal with emergencies. I have not seen any borrowing planned for those costs, a cash flow model for those costs, and in my experience, my corporate clients would be doing that calculation, making plans to borrow for it, and explaining the cost. Right. It seems to be that that transition in dealing with it seems to be completely missing from the town's analysis and your analysis.
I think that's mostly a matter for the town treasurer, collector, and accountant. We haven't gotten into that level of detail in terms of the criteria that this committee was charged with in terms of ascertaining financial feasibility.
Okay, thank you.
Sure. Okay, it's 10 p.m. Any other questions? Okay. Well, first, thank you for spending the time in the first of what will be 3 meetings for the committee, the next one being tomorrow night to address governance, and next Wednesday, engineering. Before I accept a motion to adjourn from the committee, I just want to particularly thank Ed Siegfried for his financial analysis, steadfast and meticulous work addressing a complex subject, as I think we've heard from multiple folks tonight, over the past 6.5 years. I think his diligence and his availability consistently really set a very high standard for volunteers, and I want to personally say thank you for that.
Second that.
Second.
So I will now accept a motion to adjourn.
Make a motion to adjourn.
I have a second.
Second.
All in favor?
Aye.
Aye. We stand adjourned at 10:02.